Investing India, who don't want to invest in equities, there are few options remaining. I am Dr. Rahul Deshmukh and I am not a advisor, financial advisor. You have to assess everything before investing. First thing, cash. Cash wipeout is very low, liquidity very high, tax efficacy low because there is no cash earns little or no interest. The liquidity is excellent. I told you immediately available. Inflation risk is there high. 10 lakh rupees today will not substantially having 10 lakhs tomorrow. Power after 50 years. Best uses for emergency funds, near-term expenses, opportunities during the market corrections. Problem, keeping a very large percentage of wealth in the cash can significantly reduce long-term real returns. Necessary. About 20% cash ratio is necessary. Second, PF, PPF, EPPF, wipe up risk is very low. Tax efficacy is generally excellent, particularly PPF because of its tax treatment. Liquidity is poor because there is a lock-in period and restriction to withdraw the cash. As compared to equity, returns are very poor, but it is a component of the limitation in your portfolio. According to best for retirement corpus and capital preservation, verdict excellent, defensive, but shouldn't be expected to generate equity like returns. Third is fixed deposit. Wipe up risk is low but not zero. Any bank go to bankrupt. Growth is low. Tax efficacy is moderate to low. Individual applicable rate depend on the what FD you are doing. Advantages are simple, predictable, and useful for planned expenses. Major issue, post-tax return and inflation can make the real return quite low, even negative. It is for your emergency funds. You have to look at that point. It is good for stability and short and medium term needs, not ideal as a main long term growth engine. Apartments in tier 1 city, tier 2 cities, or tier 3 cities. Tier 1 cities, you get an expensive apartment, and but return on the rental basis is very high if there is good locality. Tier 2 and tier 3 cities, you get cheap apartment, but again liquidity issue is there in tier 1, tier 2 and tier 3 cities. Tax efficacy is moderate to depend on the rental income, capital gains, and financing and holding period. Cash flow usually poor to moderate compared with the capital invested. Liquidity is poor. Selling 1 crore of apartment is not like selling 1 crore of your equities or mutual fund. There are stamp duties, registration, brokerage, and taxes in there. It is concentrated risk very high when properties are in the same city or locality. Rental yield often relatively low compared with the market value. Advantage, potential inflammation. Disadvantage, large amount of capital gets locked in a single asset. The important distinction, owning one excellent apartment in a strong location is very different from the owning 3-4 mid-size mid-core apartments simply because the property is safe. Verdict, good wealth preservation, diversification, but I would not automatically keep increasing the property exposure once it become a large percentage of my net worth. Fifth, gold, silver. Wipe out, wipe out risk is very low, particularly for the physical gold held secularly. Growth moderate over the long period but highly cyclical. Tax efficacy depends on the which form of a gold you are purchasing. Cash flow is nothing, no. Liquidity is good for gold, somewhat less attractive for the physical silver. Inflation currency hedge is main advantage of this keeping physical form of gold, not silver, because silver is a industrial requirement is also there, and therefore it is very volatile depending on the industrial output or industrial demand. I would consider gold the core precious metal. Holding silver is more volatile and has greater industrial exposure. Verdict: excellent for portfolio, but usually not for main growth engine. Last, mutual fund. This is most important category to differentiate. Mutual funds are not one asset class. They can certain equities, debt, gold, international stocks, etc. Equity mutual funds wipe out risk is very low for a diversified long-term portfolio, but short-term drawdowns can be substantial. Growth good to very good, tax efficiency moderate to good depending on the mutual fund, and holding period. Liquidity is excellent compared with the property. Diversification is excellent, compounding major advantages. Disadvantages is market volatility. Best uses long-term wealth creation, generally for 7 to 10 plus years. Debt mutual fund, low volatility than equity funds, useful for the fixed income component, but taxation and risk characterized by differ from the bank and PPF. Verdict: for long-term wealth creation, diversification, equity mutual funds are probably the strongest asset in this particular list, provided the investor can tolerate market volatility. I would divide the portfolio into four jobs: liquidity, cash, FD money you can net soon. Second, safety, PPF, EPPF, debt instrument, protect the core. Third, growth, equity, mutual fund, create long-term wealth. Diversification, property, gold, protect against different economical environments. The mistake is to ask which investment is safer. The better question is what percentage of my total wealth should perform each job. I think my division: 20% cash, 20% mutual fund, 20% real estate, 10% gold, 15% in PPF bonds, 5% in FDs. This is for non-equity portfolio. If you can invest in stock market in India and US, then 60% it should go to the